good morning and welcome to the Killik & Co podcast, the 9th of June. Well, last week it was all about the ECB and expectations running into the ECB meeting were high that the committee would actually introduce some interest rate cuts and possibly some other measures into the system in its fight to avoid deflation. Inflation numbers in Europe have been running towards the sort of 0.5% level, but that's a mixed bag. Obviously, some of the stronger nations are enjoying in-line levels of inflation, but it's some of the weaker economies within Europe that prices are beginning to fall. And the pressure was on the ECB really over the course of the last month to come up with something new to try and battle the consequences of deflation. Expectations are running high, but broadly the market felt that what was announced largely met or exceeded expectations. Rate cuts, there are 3 interest rates, and the sort of headline rate came off by around 10 basis points. The marginal lending facility down around to 40 basis points was a larger cut than expected. But some of the other measures introduced designed to push further money into the system were broadly met with lower yields across Europe. The euro itself, which was trading against the dollar around 136, moved slightly lower for choice on the back of it. So generally regarded as a bit of a success, given that expectations were so high. The week ahead, well, it doesn't look quite as active as last week. The sort of key highlight for this week, if we take a look at the diary or expected diary for the week ahead, would focus on Thursday, where we have the US weekly jobs report and retail sales. Now here expectations are quite high again for a fairly bumper sort of statement from the retail sales number, and this really it becomes more important when you try to build out the components for all aspects of the US economy for the important Q2 data. We're entering into March, obviously the sort of third month of the quarter. So far it hasn't looked too good. The numbers, for example, like the trade deficit, industrial production, some of the PMI surveys have largely been missing targets. There will be reasons for it, but nevertheless, when you put the whole thing together, the question mark has to be, are we expecting too much of a bounce back in the US GDP number for Q2? So this retail sales number, I think, will have some significance for what is otherwise a reasonably quite weak. Now, in terms of market comment, really this next chart is what a lot of investors are talking about, which I've highlighted before, but it is the volatility index. And really it's just to record the fact that the volatility index, the VIX, is recording a number now below 11, 10.73. You can see how this chart is breaking down. So very low levels of volatility at the moment, and so right across the asset classes, it's not just stocks. This is the S&P 500, but it is across currencies, for example. You're seeing quite low levels of volatility at the moment, and as a result of that, you're seeing volumes decline across the board in financial markets. So it's often a sign of what we describe as an area of complacency. It's a low volatility, grind high market, and that continues until an event sort of changes direction of it or brings more volatility in. So a sort of surprise, and we haven't had too many surprises, which you can argue is good. But the net result of it is that markets are displaying the lowest level of volatility we have seen now, really since the ending of the financial crisis, and so that's just something to watch out for. But we are seeing stock markets sort of push ahead. This is the German DAX. Had a good week last week and pushed up to that 10,000 level, that all-important level. It does lead the FTSE 100 index sort of very, very close to breaking its year-to-date high, and that in itself is going to be sort of quite close to breaching its all-time high that was recorded back in 1999. So one of the last of the major indices to break that level. It feels not far away before it is capable of doing that. Just in terms of some of the stocks, it's worth mentioning that Apple has had a stock split, so if you suddenly see Apple on your statement trading at $92, do not be alarmed. There is a stock split. The chart here describes the fact that really over the course of May and June, it really has had a very good sort of 6-week period, and this is in relation to thoughts of new products. There was a tech conference. They announced some initiatives, including the new iOS 8 and the health fitness apps which are coming through. Nothing too much to get excited about, but it really heralded the sort of opportunity for things such as the iWatch for later this year. And the market seems clearly to be in positive mood towards Apple at the moment, so that's pushing towards new highs. Really just a couple of other stocks to mention. We noted the sort of trading pullback in some of the house building stocks. That seems to have bottomed out, quite sharp rallies in the house builders. This is Berkeley Homes, which is on our buy list, rallying from £22 to £24 over the course of last week. So that was quite a sort of sharp snapback. We still do like that sector for investment. We had the buy note out on Walt Disney. That also enjoyed a fairly good week last week, again rising up to the highs. In terms of results, particularly pleasing I thought were Wolseley numbers, strong in the US and UK, pretty much in line. Still some issues to deal with in Europe for them, but I think heralds well for others in the sector, such as Travis Perkins. And just finally, we've got United Utilities. It is fair to point out that with the lowering of yields across the globe, with the US 10-year and European yields particularly hitting new lows, it is obviously pushing more and more money back into the utility sector at the moment. United Utilities having sort of pushed up from 750 to 886. This is a level where we'd be quite happy to take a little bit of profit. We think a turnaround in the yield market would start to reduce some of the sort of short-term attractions of this sector, and we think it may have run a little bit too far. So United Utilities, we continue to take a little bit of profit into this quite sharp rally we're seeing at the moment.